what do you want to talk about the little bank earnings preview here today?
Yeah, I wasn't going to preview the bank earnings. I was going to say that for Monday's show.
Okay.
Because,
Okay.
but I will say, listen, at the end of the day, the bank earnings are going to be incredibly robust, probably the best quarter of the year, and everyone knows that. So the trade is going to be on the guidance for the second half, and I think the guidance is going to be cautious because so much has changed, since the middle of June with Warsh's hawkish statements, the Iranian peace deal being off the table. So it's going to be a very different backdrop. Yield curve is flattened. Loan growth is all of a sudden, on the C&I front, falling off a cliff. So I think that the guidance is going to be the key. But what I am intrigued by, since most of our clients like to buy things, is this rotational trade that keeps playing out, and banks had benefited from it in June. I mean, we had a phenomenal June for the banks, but we're seeing a rotation in defensives. I mean, healthcare obviously has been part of that, but consumer staples are seeing it. And the other area, and this is where I want to bring Bakes in, has been utilities as a defensive play. And as Bakes sort of commented about it in the pre-show, is it seems to be going against what bonds look like they want to do. And so I was wondering, are they benefiting from flows, purely a flow trade, out of the SMH, which seems to be breaking down. The hyperscalers aren't acting well either, so maybe there's money coming out of there as well. And then you got the lag 7. So that may be part of it, just a rotational trade. The other, may be, anticipation of an incredibly hot summer and air conditioning demands going up. So I don't know, Bakes. Technically, what's the XLU or some of these? I own AEP, American Electric Power. What are some? And I've been buying some other utilities, very small. What's
why AEP first? What's the appeal there?
It's primarily, large cap liquid name that institutionals gravitate to. They've got, low single digit type of earnings growth. I mean, mid to high single earnings growth plus a dividend yield. So you can get a total return of high single digits, low double digits.
It looks to me to be about one of the best ones out there. I was struck by the fact that I have a hard time thinking of symbols here because I just never look at these. But to me, they look like defense. They don't look like bonds with bricks. That was my first impression when I started going through them. And AEP, I think, looks like the best of the bunch. I just put up Duke and Constellation. They do not look as good. So I think you're onto something. And it's only 2 days, but we saw, I think, a pretty significant reversal yesterday with oil spiking and the semi-AI trade taking on some water. Now it's only 2 days, and peace could be declared tomorrow, but I think that's unlikely. But utilities they're looking like defense. They don't look like bond with bricks for now, for me.
Yeah. And then the other thing that I've been recommending in past shows and continue to nibble at on pullbacks are what I call, the theme is real estate. And one of the blessings of following the banking industry is they are a window onto a broader world, and you can follow where bank money is flowing to, and sometimes those are good investments. And literally for the last 3 quarters, including here in the second quarter, banks have talked about real estate as clearing. In other words, deals are clearing. Now, they're clearing at deep discounts, but the banks aren't taking any more hits on that. In other words, they've written them down to clearing prices. Prices are moving, product is moving, clearing the markets. And banks now are willing to lend again. So I think that whole real estate theme is attractive. Now, I'm not going to buy office REITs at this point, but I am buying, other types of real estate plays. So let me reiterate. The one that I really like is called Flagstar, FLG. This, if you recall correctly, is a turnaround candidate, almost failed because of an over concentration in commercial real estate. But starting in the fourth quarter of last year, they turned profitable for the first time in 2 years. They were profitable again in the first quarter, and they will be profitable here in the second quarter. Probably earn maybe a nickel a share here in the second quarter. So not, they're not earning a lot of money, but they're earning money consistently now, which makes tangible book value a real number. And this stock is trading at 14 and change, and I think tangible book value at the end of this year is going to be 16 and change. So I think it can get up to 17, 18% dollars a share by the end of the year. So the story is, one, you first have to get profitable. They've achieved that now. This will be the third quarter row. The second thing, and this is what you want to look for here in the second quarter earnings report when they report on July 24th, is are they starting to grow the balance sheet again? In other words, they've been shrinking the balance sheet for almost 2 or 3 years now. And I think you're going to see a turn in that balance sheet this quarter. And that means they've been shrinking their CRE exposure, their commercial real estate exposure, but starting to grow their C&I loan exposure. And for the first time, I think you're going to see that handoff result in balance sheet growth rather than shrinkage. That's so critical because their main source of revenues is what we call net interest income, spread income. And you have to be growing the balance sheet for net interest income or spread income to grow. And this will be the transition quarter. So just like the transition quarter for profitability was the fourth quarter, second quarter is going to be the transition quarter to start growing the balance sheet. And out of that, finally, as you start to grow NII, you're going to have improved overhead or efficiency ratios. So right now, their expenses are eating up about 80, 85% of revenues. Typical banks' expenses eat up about 50 to 55% of revenues. So I think as they grow the balance sheet and continue to work down operating expenses, in absolute dollar terms, you're going to see that efficiency ratio dramatically improve. And that's going to lead to a higher ROTCE, which gets you, to trade at or above book value. So I like Flagstar. One caveat, they put out a slide deck every quarter showing their own projections for the next 2 years. For this year, they had been expecting to earn 60 to 65 cents. That's not realistic. They're going to have to lower that, when they report earnings in July in the new slide deck. So you may get some trading off on that, revision downward. And then very quickly, let me just, unless Bakes, you want to comment on the chart of Flagstar.
No, I like it, and it kind of reminds me of Citicorp.
It does very much so.
Because you have some disaster, downward spikes. I don't know what the heck happened.
Yeah, it almost failed. It almost failed.
More downward spikes than most banks have endured. But what you have now is this is a low of 17 and change. That is the next stopping point, I think. And then you have the shelf here at 23. See all the times it hit 23. That's been that was support that blew out pretty definitively back in 24, and now you're grinding your way back up. It's always easier to destroy than to build, and I think that you've got a decent move going from 17 to 23, especially given the up volume that I'm seeing so far and the positive responses to earnings reports. So I think you're onto something.
Yeah, and then so the last real estate plays, and I'll just mention this very quickly because I've mentioned it in past reports. So, some of the REITs, Essex Property, ESS, and AvalonBay, AVB. Here, these are our multifamily rental REITs, and that's the area that I think is attractive. I'm staying away from the South because I think multifamily is overbuilt in the South. But Essex is a pure play on the West Coast. They tend to deal with high-end clientele. Both of these are more 27, 28 stories than they are 26 stories. But I think you're going to see, low single-digit rent increases and occupancy, and starting to get towards, 96, 98%. And they're very attractive names as far as I'm concerned. It's cheaper to rent than it is to buy, so I expect the occupancy to continue to grind higher over 27, 28. So AvalonBay and Essex Properties.
It's funny you bring these up. I haven't thought about these stocks in a long time. They've actually traded quite well, to be honest, as we look at them.
I'm making money. I'm up 10% on both of them.
Nice.
And these have a decent amount of interest rate sensitivity in them, don't they? They fund with SOFR?
They do. In fact, you'll see they're off, 2 or 3% this morning because of the fear of, oil prices spiking higher and interest SOFR going lower. And bonds trading off. So yeah, they have some interest rate sensitivity to them.
I mean, spiking higher. It's amazing how that $2-3 spike is. We went from spikes of $20 to $2, and we're using the term in both things. Yeah, I mean, it's interesting that when we talk about rates, is that rates have not really as oil's come in from 100 plus on the front. Now, look, I guess you could say that December never really got up there, right? Like we got into the 80s a little bit, and that was kind of that. So, but the 2 years at the highs, the 10 years damn near at the highs.
Yield you're talking about.
Yeah,
yield.
Definitely not.
Okay.
Definitely not the price.
Okay, I'm making sure I got you. Okay.
Yeah, you got to go back a few years for the price before bonds got absolutely rug pulled in 22. But Charlie, when do you think the rates on the long end become an issue for banks? Because I know that we've always talked about the 5% level being a real issue. I mean, what are we at in the 30 years 508 and the 10 years 455, 2 years 4. The 2 years staying anchored, to be honest, for the most part. Maybe that's it. As long as the front of the curve stays anchored, truth is the back end doesn't really even have that much paper. It's one of those things that equity guys like to talk about, and maybe for the mortgage market, but it's real. The real bond market is 5 years and under, and really in the funding markets, right?
Yeah, I mean the short end. Banks look at the spread from 3 to 6 month out to the 5 year. That's the spread that affects banks the most. The belly of the curve is important in terms of where it trades for a couple of reasons. Obviously, the 2 year anticipates or pushes the Fed into certain actions. So the 2 year is important to watch. And then a lot of your consumer loans, like auto loans or adjustable rate mortgages, are done in the belly of the curve. Your C&I lending is all done off of SOFR, so that's overnight. But higher rates, generally are going to create some pressure and competition for deposits. And banks have been very aggressive in lowering their deposits. I was just talking with a client yesterday about Wells Fargo. Their average cost of deposits is 1.9%. The average for the industry in the first quarter was 2.11%. And so SOFR is 360, 370, something like that. So if we have higher rates because of higher oil prices, there's going to be a real liquidity drain on bank deposits as yield-seeking investors move their money out of banks into other vehicles, and that's going to put some pressure on spreads. And right now, as banks will say, the KRE, which is the regional bank index, has been acting better than the capital markets related banks. But the KRE could come under pressure if we get some competition for deposits, because that's their core cost of goods sold, if you will, in a spread lending business. So I'm watching that carefully, and I'll tell you, Ben, I'm watching that long end. We need to get it back above 518, 520 on the 30 year for, I think, a breakout. And so we're pushing 505 these days, and on the 10 year, I think we have to get back above 470 for a breakout.
I mean, you also got to remember that it's not just the level, right? The rate of change is what really matters, right? And so if you think about March, we had a VAR shock blow up, right? And, yours truly got totally smoked on his Z7s as well. So I caught that fray as well. But there was a lot of guys who were all along the short end of the curve that got blown out. but this has been pretty orderly, right? Like it's kind of drifted up a little bit, but it's not really moving with it. Because if you look at like the move index, it's like at 70. It's not like at the lows, but it's. I mean, in March it was 118, so that's been pretty supportive in general. So I just think it like with banks, like maybe vol picks up, rates are up here, maybe that like contributes to them being weak, on a go forward off these highs. I don't know. What do you think about that?
Yeah, I mean, I'm going back to the yield curve and just thinking about it. The peak steepness in this calendar year was around 70 basis points in February. That's between 2s and 10s. And then we had, a flattener trade, but a bear flattener trade, from February, into roughly June, I'd say. And now we're going back to a bear steepener. And the bottom line is they're both bear trades, whether it's a flattener or a steepener, they're bear trades, and that's not good for banks. And banks are, at their historical high in terms of relative multiples. I mean, banks trade at 50 to 60% of the market multiple, and they largely trade there because their balance sheets are viewed as black boxes. No one really knows what's in those loan portfolios, and they can't value them, so they discount the valuation. So if we get into a higher rate environment that starts to stress, corporate lending, then that discount's going to come down from 60% back to 50%, and we're at the high end of that range right now. So I can't buy bank stocks here. I just can't. I'm sorry.
No, I'm with you completely. I'm 100% with you. We talked about that. Let's see where this thing's at.
Ben, we're in the minority. I'll tell you, every strategist that comes on Bubble Vision is saying, and you got to buy financials. All the bank analysts are falling over themselves, bullish about financials, and it's largely because of three things. One, deregulation is going to lead to higher valuations, and we can talk about whether that's valid or not. Two is the capital market cycle has no end in sight. And three, that credit is very benign. So those are the three bull arguments. And one of the things I may have underestimated in turning bearish here recently is the flows coming out of tech into financials have been substantial.
Yeah, I think that's probably partially some of it. You've seen, honestly, the picks and shovels guys. I was looking at the board, like it's down. They're down a lot. Like they've been derated pretty good here. Like my CoreWeave short's down almost 50 or 60 off the all-time. All right, it's 52-week high, but a lot of the stuff's down 15, 20 to 30% on the AI capex beneficiaries and hyperscalers, and so that money has been going. Healthcare, our boy David Maris's sector's been good. Biotech has been really good. Materials has no positioning there. Consumer cycle, like we talked about that, Charlie, with Home Depot in May, and it was left for dead. No one wanted Home Depot, and it's had a nice move here. So I think that's right. I think there is some reallocation. I'm always skeptical of June though, because you get that year-end Russell reconstitution, rebalance, whatever you want to call it. So let's see as we get going here. This is around the time where the lowest part of the vol suppression of the year is over. Usually it's like June 26th, 27th till about July 6th, 7th, maybe the 8th. Remember July 24, we had, highs. And then one day NASDAQ was down 3% and the game was on, finishing with the Nikkei down 10% in one evening on August 5th. So we'll see. Kevin, what do you got here, buddy? What do you think about?
I learn a lot from my own portfolio, and as I mentioned with Stephen Lamar a couple of times, I just go through and when my sell trigger is hit, I just go, and so I sell things when I'm wrong. If I have a cost basis and I'm 50% in the red, I just get rid of it. Copper's been a winner for me. COPJ. This is the opposite. COPJ sold some around here when it got to be 13, 14% of the portfolio, and when I had a double, And now today I'm selling my last 4% or so at a 56% gain, but I'm gone. And copper is not working. Frankly, another ETF, rare earths, REMX, isn't working, and drones, DRNZ, is not working. So I'm getting rid of three, locking in a winner, kissing my sister with REMX, and invoking my 15% rule on drones. And I'm going to be about 50% cash at the end of the day, and 50. And so I've got my shopping cart out. I'm going through my 5,500 charts, and I'm looking for new ideas. But copper to me is emblematic of what's going on. It's the metals are rolling over.
On that front, Bakes, I did buy just recently Ivanhoe Electric IE, which is a domestic copper play, at around 9. IE is the symbol. And
I know it.
It was a name I used early last year, made a lot of money on it, and I just got back in small because I think I'm trying to catch a falling knife here. So I agree with you. There's probably more downside in copper short term, but I'm going to be accumulating as it comes in.
Yeah, so that's what I'm doing. I got a couple other things real quick if you have time.
Go for it.
Yeah, keep going. We always like to hear what the chart master has to say.
Oh, God bless you. This is SMH, the VanEck Semiconductor ETF, and it's always been kind of the granddaddy for me at least. And what I'm drawn to is these red. I hate my new chart system, but you see this pink down here at the bottom, the down volume. The down volume has been persistently picking up as the stocks hit new highs. And that's just a lot of people saying I've made way too much money on NVIDIA, Intel, probably MU et al. And there's termites in the foundation of the semiconductor trade. Now, could it reverse and could things rip off to the upside? Perhaps, but it's not the way to bet. So you've got an extension over the 200 day, and you've got down volume picking up not just for a day. I mean, this is 2 months at least where people want to sell these things more than buy them. Now, obviously, there's two sides of the trade, but you get the idea. There's distribution going on, in my opinion. And I would be really careful if you own semiconductors here, especially if you got big gains. Just lock some in and move on. But this really caught my eye as I was going through them early this morning.
Yeah, on that front, Bakes, I'm short EWY, which is the ETF for the Kospi, and that's a stock that is broken and is in distribution. It's in clear distribution now.
Has Hynix done its ADR yet, or is that coming up this week?
Friday.
That's
Friday.
Yeah, that might be the bell, literally and figuratively.
Yeah, I kind of think that you're looking around and you're seeing the hyperscalers kind of outperform a little bit recently, and I think that it's both Meta and SpaceX kind of announced that they're going to do some NeoCloud stuff to try and shore up their cash, in their balance sheet and all the spending. I think that people were not happy when they heard Apple was going to jack up prices 20%. That kind of was the bell ringing that all this CapEx from private credit and the hyperscalers is now funding or now filtering through to real consumer hardware and products in a real way. And so I just think we're in a situation where there's going to be a pause in the CapEx, and it's going to I think the market's starting to anticipate it. I've been talking about this for a while. It feels like over the last month we've gotten a lot of that, but that seems what's going on there. Look, the Kospi's down 25%. I mean, that, Kevin, you ever trade the Kospi? That might be the craziest index since Taiwan and Japan.
I think what Samsung and Hynix are 40%. Or more of you're basically buying two stocks.
With the company. They are. But the problem with
that looks pretty head and shoulders-y, doesn't it?
Does it? No, definitely. No, I mean, I'm now, I'm seeing the same thing you are, and then I keep asking myself, what's going to make it roar to the upside? Having a secondary listing or an ADR listing, that doesn't sound like a catalyst. That sounds like distribution. So I
The
wouldn't.
problem,
I wouldn't. Nvidia can't get out of its own way forever. That doesn't look great.
Ben, the problem with trading the Kospi, as a U.S. citizen or retail investor, is you have to exchange out of dollars to buy the futures, and they're not going to let you do that in small size. It's going to cost you, and then you have the currency risk. But I have done it. It's not a good trade, so I went back to doing the EWY because I do trade futures a lot, but I would say the Kospi futures are not a good way to.
Interesting.
Yeah, I mean, I guess the thinking is that, but it doesn't even really matter because that thing just jacks up, jacks down on the open. So I don't even think you're getting any advantage from that, And now look, if you're big, you probably want to do it, but like you have the 24-hour trading on Interactive Brokers and some of these exchanges, so you can get some volume in the EWI. Now, not anything like massive, but that thing trades. That if you're a degenerate trader, that is your stock index, the Kospi.
Yeah, and I'm not trading it. I'm in there for the Eiffel Tower. It went up to the top floor and it's going back down to the bottom floor. So I'm.
You mean the Christmas tree of death? The Christmas tree.
Yeah, I was just going to say we've got competing metaphors. So
yeah, I'm in for the Eiffel Tower.
I formalized that. I have a list of 100 or maybe 200 stocks over the last 100 and some years that fit that, and then I put some decline curve logic on there, and I got a whole thing. I'll eventually share it with people. But yeah, I was laughing. I even put Jeff Mackey up there, named by Jeff Mackey. But that, whatever you want to call it, Christmas tree of death, Eiffel Tower. It is an interesting thing because it seems, and again, I don't know definitively, but it seems like we're getting that pattern a lot more in the post-COVID period. I think the options are a big part of it because it's leverage driven.
Leverage ETFs, no.
Yeah, zero DTE trading. But Ben, you also have looked at silver, which had that sort of same blowout off the top. And you,
I picked it. I caught that negative 37% day, which was a good one.
And these unwinds sometimes. I'm not talking about silver here now. I'm talking about the Kospi. They take 2 years, and the first break sometimes it breaks the 50-day. Breaks if you're a technician, Fibonacci levels, all those kind of things. I don't necessarily follow those, but and then you rebound, and then you break again, then you rebound, and that volatility is what keeps you honest, or people off sides, I should say. And so it takes time before it really breaks solidly. And so that's why I say I'm in it for the long run. I'm not trying to trade this.
I mean, maybe. I don't know. I'm not sure that's going to hold up for the Kospi because the Kospi's 2 stocks, and there's a huge amount of degenerate leverage in Korea. That thing, I mean, look, it's already down 25. Let's just say March low was 5,100. So that's another, was that 30% just to get to the March low? That would be 50-some% total. That would be a pretty quick retracement if you ask me, right?
Yeah, that would be.
Yeah,
but I'm talking about going way back. As I said, Eiffel Tower, taking you down to the basement.
Well, I will say this, and then I think unless Kevin has one more thing, we had a guy who's based out of Shanghai on Betty and the Squirrel podcast, and he kind of got me looking at that CMXT and YMC, the 2 Chinese NAND and DRAM companies that are going to double their supply in the next 2 years. And even Trump's talking about, maybe lifting that ban on that. So while, Micron and SK Hynix and Samsung kind of have been real coy and cutting, just to jack up pricing, just because, look, you got to give them some flowers. It's a bad business. This is their moment in the sun. They're making money, just like a copper miner or a uranium miner or any bad commodity business that every once in a while gets one of those periods of super profits, But they always do the same thing. They never last, do they? Like they go.
No. Yeah. So Bakes,
All
what do you
right.
got
Well,
left?
Kevin, you got anything else? Otherwise, I think we're gonna get out of here. It looks like it's at half past.
What'd you ask, Charlie?
What do you have left?
I put up the government chart, GOVT, U.S. Treasury Bond ETF, just caught my eye, and it just looks negative to me. That talk about a head and shoulders. That looks like this is the daily, a head and shoulders, and we're looking at 20. This is the ETF, GOVT, and 2247 is right here, and we're at 2255, and I just. Ben, what's the bull case for bonds, and what's the time frame, please?
I mean, bull case for bonds is that real rates are like 200 plus bips, and you can lock in 10. Like if you're a boomer, right? So say you're 75, 70, somewhere in that window, you got an implied yield in the stock market that's like absolutely dog shit. And so your forward returns when you do here's when we're at this level of valuation. I mean, we're at a 41 Schiller PE back where we were in 2000. And so you'd say, okay, well, equities aren't giving me what I need. Now, there are going to be equities that you can do, don't get me wrong, but as an aggregate, well, I can be in bonds, and then basically, let's just be clear, this whole, LLM AI CapEx boom is a credit boom. So this is much more similar to '08 or, one of these episodes where credit is a big part of it. And there's a big real estate component to it, like '08 as well. So let's just say that goes awry. Well, they're going to take rates down. They're going to take rates down because all these private credit guys Charlie and I have talked about it. I had this private credit research person on my podcast last week. Like those guys all fund with SOFR. So they'll have to take it down. It's just basically like all contingent on this CapEx boom. If you go back to '08, we had a double CapEx boom of China and U.S. housing, right? So you had like materials were the hot stocks. Kevin, I bet you remember those dry ships. Remember the dry bulkers? They were the memory of back then. The memory stocks of today were dry bulk shipping back then. But
VLCC.
In the summer of '08, inflation was 5%, and oil went to 147. And everybody talking about inflation, and no one was talking about inflation by the end of the year. So these things have a way of they can turn fast. And the one thing that's trickier about here is a lot of these are commitments for multiple years. So I would argue, to be honest, that I think we peaked. If you go and look the Mag 7, Oracle, Oklo, SMR, just across the board, last fall was when a lot of this peaked. And the turning point, and I'm writing all these essays about bubbles and comparing them now. The turning point in these bull markets or CapEx boom is usually when the market stops rewarding you for putting more capital to work, right? And that's been happening for a while. Like Microsoft and Meta and some of these other guys have been either down to the right or basically derated. And you could say, oh, Google, but Anthropic has been a monster rise for them, and they own a big stake of that, right? So. And remember, Anthropic in the Q1 was half their earnings. The equity gain on sale accounting. I mean, I'm not saying the market capitalizes that, but I'm just saying that in terms of GAAP earnings, it was half their earnings. So I don't know. I think that it can push us where the belief is starting to be in question, but everybody kind of still has the narrative because the spending's going on. There's these commitments. Credit guys aren't really the private credit guys. They got to put money to work. So, maybe Charlie's right, and some areas of real estate will start being interesting. But I think data centers have been pretty easy bet for them for a while. And so that's been the comfortable place to put money. So that to answer your question, that was a long-winded way of saying that, sorry, is that basically if we roll over, which is pretty much going to be contingent upon two things, either the CapEx boom rolling over, or maybe Trump loses the midterm, or the GOP loses the midterms, Dems don't do them any favor. Maybe that, you start to get the budget kind of come in, you get a government shutdown type of thing, something like that. Yeah, I would guess that rates would come in because there's going to be a point where guys are going to be like, you know what, I don't need to deal with the S&P going back to 5,000 or 55, whatever. You can name the level. I don't really care about that. But like, I think that there's been a really good run. 75. I didn't think we were going to see 7,500 this cycle. Did either of you guys think that?
No, definitely
No.
not.
Yeah.
No.
So I mean, hey,
And
don't look at
now
gift
8,000
cards,
is
right?
sort of 8,000 is sort of the consensus, calling card for the strategist. So that makes me a little bit nervous that that's become the new target.
Yeah. I mean,
And all of that is based on, this idea that, earnings are going to grow astronomically. What are the estimates for 2000 and is it like 400 for
Yeah.
next year?
Exactly. 20 times 400. That's what they're doing, pretty much.
Yeah. And, it raises the question is, and other people have said this, is it not a stock bubble, but an earnings bubble? And our estimates way too high. And in my industry, the banking industry, Jamie Dimon has been very public about saying this industry is over-earning, that the loan volumes are above norms and the capital markets volumes are above norms. And, you can't sustain that. And, you got, 16% ROTC on average, but, banks like JP Morgan are consistently earning a 22, 23% ROTC. Those are not normal returns. So I would argue, that maybe it is an earnings bubble and people are extrapolating, current earnings today into 27 that are unrealistic.
yeah, I mean, it's completely an earnings bubble and it's a valuation bubble. Like, some of the air stuff like an Oklo or an SMR, those things have been toasted. Bitcoin's been toasted. Like a lot of the fake stuff. So like, but in general, I have some charts that show we're like 98th, 99th percentile. And again, Shiller P's at 41. Like there's only one other time over 100 since 1870 that multiple has been there. Okay, you have the late 90s. But what I'd say is if you think about like the Kalecki profit equation of just rearranging the GDP, like to get it to where profits come from, just got to remember when you do a CapEx boom, the revenues are recognized, but the costs are not fully recognized, right? So from an accounting perspective, you have that has to match, like it's an identity. So it's not a surprise that you have earnings booming because the CapEx beneficiaries are getting 100% of the spend, but the hyperscalers are capitalizing 15, 20% of the cost. So that gap just ends up in the S&P earnings. But, on the other side of that, it's not like it's actual cash flow, right? This is just a GAAP earnings thing. This is just an accounting thing. You're turning cash into earnings, basically. But we'll see on the other side. So, all right, man, I think we got to call it. We ran over a little bit. Good show, fellas. We are Wall Street Beats. We'll be back tomorrow. Enjoy your July 8th. I'm Ben Bry. See you later.
Thanks, Ben. Thanks, Biggs.
Later, guys.
Thank you, gentlemen.
Thanks, Ben.